Hello, everybody, and welcome into Commodity Culture, where our goal is to make you a better investor in the commodities sector. My name is Jesse Day. Today is April 8th, 2026. Before we dive in, standard disclaimer, nothing here is investment advice. Do your own due diligence. And my guest today is the head of commercial applications at Trilitech and the product lead of metals.io, a digital platform that allows users to invest in uranium, gold, and other critical metals powered by blockchain technology. It's Ben Elvidge. Great to have you back on the show.
Great to be back on the show. Thanks for having me, Jesse. Really appreciate your time.
Well, let's start off with the uranium market today and your current assessment of the sector, because from my perspective, long-term contract prices are rising, the tailwinds behind uranium appear stronger than ever, and the nuclear renaissance is in full swing. Would you agree? And what are your overall thoughts on the health of the uranium market right now?
Yeah, I'd absolutely agree. The uranium market, as we look at it, has never looked healthier from a structural demand perspective. I think one nuance worth mentioning, and a lot of viewers will see this, right, is the fundamentals and the spot market versus where we're seeing the term market head are telling two slightly different stories, and both matter, right? We saw earlier this year in 2026, obviously we saw a big run up, which was great for a lot of people in the spot market. That seems to have settled more recently around the mid 80s per pound, in dollar terms per pound. But more significantly, which I think is the right sign given the fundamentals and the demand. We've seen the long term contract price climb to a reasonable level as well, right? And so that's the price that utilities are actually willing to lock in, and is probably a fairer reflection of the demand versus supply sort of dynamics that are at play. And so I think while the demand side is unprecedented, and we see that from the big producers saying that firsthand, right? Grant Isaac at PDAC at March was talking about uncovered utility requirements and future demand not yet contracted, and that never being larger. So that's another great sign. And so, as we look at it, what all of that means is that between now and 2045, let's say, there's a massive wall of demand that can't be avoided. We're seeing reactor life extensions to 60 years across the US fleet, huge amounts of new builds, even in the UK where I am, where, we've got Sizewell C up kind of underway, but in the US, China, India, Korea, and of course, not forgetting that's just the government demand. You overlay the AI data center thesis driving power demand higher, and the private company demand side dynamics driving that further. The projections are sort of unprecedented in that regard. But as I talked about last time as well, the challenge in the uranium market is on the supply side, we've still got that structural deficit. So even despite some positive news from Uzbekistan and, Paladin are well underway with ramping, the Langer Heinrich mine as much as they can. The gap between what the world needs and what's being mined continues to keep widening because of that almost exponential demand side. So the nuclear renaissance, as I think about it, isn't just a talking point anymore. It's actually becoming a capital deployment reality, not just kind of from an investment thesis perspective in uranium, but also how do we get more capital into the supply side? Because, as I mentioned before, that wall of demand that we're facing into right now is already unprecedented and is only going to get higher in my mind.
Great summary there. Now, I want to step back and look at kind of the overall commodities complex, because the war in Iran has already had some pretty serious impacts on the commodities sector, particularly energy. But of course, the Strait of Hormuz was not completely closed, but shut off to those who would not pay a toll, shut off to American and Israeli vessels or those allied with them. I mean, the fog of war obscures so much. Now we've seen potentially some sort of agreement, a 2-week ceasefire being announced by the Trump administration. We'll have to see how that all plays out, because it looks like Iran and Israel are still attacking each other. The situation is very tenuous. I think we could be far away from any real lasting peace at this point in time. I think this has kind of shown a light, though, on just the importance of commodities. We see not only oil, but natural gas, urea, many other vital commodities that pass through the Strait of Hormuz already experience quite a rise in price. What are your thoughts on this? And do you think this has highlighted the importance of commodities in an increasingly uncertain geopolitical landscape?
Absolutely. Again, I think that it's been a masterclass on why commodities matter and why commodities supply chains are so critical. And more importantly, why access to them can't be taken for granted. Not just oil, as you rightly say, and the volatility in oil, I'm sure, is an oil trader's dream. But for the rest of the world and the cascade effect that that's had, that's huge, right? It's not just an oil story anymore. So LNG flows, as you said, Qatar declaring force majeure on all its exports, fertilizer supply and urea, as you say, the Gulf is about 35% kind of global urea exports. Aluminium prices have spiked, sulfur supply has collapsed, and even, more esoteric things like helium markets have been massively disrupted by this. As we look at that for our world, which is metals, that lessons equally stark. That geographic concentration of supply still remains that systematic or systemic vulnerability. So, oil is a good example where 20% goes through Hormuz. That's been disrupted and has that cascade effect. But if you look at other metals, rare earths through China and the geographic concentration there, we saw that in the early days of this US administration and sort of the rare earth metals demand and the boom that came from that early last year. Uranium through Kazakhstan and Russia, it's well documented, of course, but how do we deal with that? I think it's interesting, maybe the precedents being set when it relates to oil and what the US administration have done there to sort of ease the sort of macro structural challenges there with reducing some of those sanctions. Going back to my earlier point around structural sort of deficit in uranium, could something happen there? Potentially. But I think the pattern remains the same fundamentally. So when geopolitics disrupts a concentrated supply chain, there's no really quick substitute to that. And I think, which as we look at kind of that and what we've built in metals.io and uranium.io previously, what it's about is giving more people and more capital a means of supporting that and accessing that, because that structural shift that's already underway that needs to accelerate is moving away from the sort of just in time, what do I need sort of model to a just in case model. And we're seeing that strategic stockpiling happening all over the world. So supply chain diversification, reshoring of capabilities. The US obviously launched Project Vault to get the critical minerals stockpile. And I think that's really a result of seeing what these single choke point closures can do to the global economy. And fundamentally, nobody wants to really disrupt that global economy to the extent that we're seeing right now, if this can, and particularly if this continues for the long term. So I think, in short, for investors, it's a pretty clear signal, right? In that physical commodity exposure's not just this niche allocation anymore that you kind of do if you kind of have a particular penchant for hard assets. It's now becoming a core strategic position that people need to think about. And we're seeing that discourse and narrative play out, right? Not just in the physical commodities themselves, which typically have been hard to access, which we're hopefully helping to address, but also in the miners, the sort of more picks and shovel trade, quite literally, to be able to sort of make that sort of halo trade something that becomes a core part of your asset allocation, as opposed to something that's just purely there to diversify and protect in the worst case scenario.
Absolutely agree. And you mentioned rare earths there. I want to get into that in a moment. But first, I'd love to get your thoughts on the gold sector at present. Obviously, a very impressive run for the metal. It took a bit of a hit in the aftermath of the war in Iran. Seems to be recovering, but nonetheless, still at a very impressive levels, 4,700, 4,800, somewhere around there, probably going to climb back up to that 5K level if I was to venture a guess this year. What do you see as the main catalyst currently driving the gold sector? And do you expect us to potentially see new all-time highs before the year closes?
Look, I think gold is doing exactly what gold is supposed to do, dare I say, and then some. And what I mean by that is there's a lot of tailwinds driving the gold demand from a defensive allocation perspective, right? So central bank, that flight to quality from central banks continues. So the central bank buy-in is continuing at record pace. that obviously contributes quite significantly to gold prices annually. And then, the structural trends around de-dollarization, we come from more of a blockchain background. We look at stable coins, we look at reserve diversification that's going on there. And so gold is a natural sort of place to sort of invest in that regard. And sort of thematically in the first part of our conversation, right? The Iran conflict has sort of turbocharged that safe haven demand. And so even before the war or the conflict has started, gold was already benefiting from these persistent inflation concerns, elevated government debt levels and what that means, as well as geopolitical fragmentation. I think, we've seen not just Iran, but obviously what happened in Venezuela and elsewhere. So people are still looking for that defensive safe haven flight to quality asset. But what's interesting is that gold's not moving inversely to the dollar in the way that the textbook would typically suggest it should, right? That relationship's become much more complex. So you're seeing gold and the dollar find support simultaneously because the drivers of that are different, right? So the dollar is supported by having relatively high US rates still, and the domestic energy insulation, whereas gold is supported by everything else that you would expect a safe haven asset to be supported by. So inflation expectations, central bank accumulation, and a genuine fear about the global order and the reshaping of that. As we think about it for metals.io, it's got a very specific portfolio function, right? It's the anchor asset that's most liquid recognized store of value. And so being able to access that on metals.io with uranium and rare earth metals on a single platform can give investors a portfolio that is uncorrelated, that spans defensive and growth oriented commodity exposure. And I think the uncertainty in this environment and sort of the lack of predictability more so than at other times in the markets is sort of why we built metals.io and why we think it's a great opportunity for us.
Rare earths have been a hot topic recently, particularly with export restrictions coming out of China. The fact that China itself processes such a massive amount of the global supply chain of rare earths. These metals are vital for a number of industries, including defense, which of course is in the headlines these days. What are your thoughts here on the rare earths market, and why do you think it's important for investors to have exposure to the sector?
Yeah, I think from a market perspective, I think the supply chain vulnerability conversation gets and the kind of geographically constrained nature of that market is sort of quite worrying, and but that also means the investment opportunity is arguably the largest. So, the rare earth market that's around about depending on where you look, about $8 billion in 2026 is projected to reach, close to 40, just short of $40 billion on the high estimates by the mid 2030s. But China controls 70% of the mine output by most estimates, 85% of refining, and critically 90% of the magnet manufacturing. And then what you saw last year in April is China obviously announced export controls covering medium and heavy rare earth metals, and extended that further in October, including some magnets as well. Again, if they control 90% of that. So that has a massive ripple effect. So the demand side is non-discretionary in a lot of cases. So every EV traction motor, every offshore wind turbine, pretty much every advanced defense system relies on key rare earth metals, and particularly the magnets that are kind of powered by those rare earth metals. And that's growing as well, annually. And so you can't build the energy transition, which we kind of need to do, and you can't build the future of our society without having access to these assets. And so that's kind of, as you look at it, that's why the US launched Project Vault, to sort of stockpile these critical minerals. Japan has started to explore deep sea mining of these rare earths, and more Western governments are now treating them as sort of a national security priority. But for investors, that's a kind of that's a layup for most commodity investors, right? In terms of demand, barriers to access. But for most investors, how do you even get access to these physical assets? You can't buy, for example, neodymium on a commodity exchange. You can buy the mining equities, but within that, you've got all of the stuff that goes along with equity risk, management risk, jurisdiction risk. It's not the same as owning the underlying actual material. And that's precisely the gap that we're looking to fill with metals.io, because we do see it as a critical market, as a lot of governments are seeing that, and the demand is increasing exponentially, but they just are not something that most investors have been able to access today.
Well, let's talk about metals.io, because last time I had you on the show, we focused on uranium.io, which allows users to trade physical uranium digitally. Now you've expanded to include other metals. What made you decide to open this new platform? For those who are new to the story, how does it work?
Yeah, so it's great to be back on, and as we spoke in September, uranium.io was about proving that core thesis, and that you could take a complex regulated physical commodity, combine modern technology and blockchain rails with institutional grade custody and compliance, and make it accessible to investors who'd never had a pathway to true physical uranium, right? We of course know there are listed products, but we see some problems with those that lots of people in the market have gone into. And so what we realized was that the infrastructure that we built for uranium, that whole stack, was fundamentally asset agnostic. The custody framework, the compliance rails, the on-chain issuance, and the physical redemption mechanics, all of that translates to other assets as well, be that gold, rare earths, platinum group metals, and other base industrial metals as well. And at the same time, the demand signal was sort of impossible to ignore. Investors weren't just asking for uranium. We had a lot of inbound on when gold, and can you do rare earth? What about copper? What about nickel? What about cobalt? And so what we saw was actually a barrier. We from and one of the learnings on uranium.io is asking people to come to a single platform for a single asset becomes a harder sell, despite the fundamental thesis and interest in uranium. If we could actually take that and combine that with other assets, it becomes much more engaging and a much more topical and relevant and sort of, dare I say, ideal place for people looking to play the commodities markets, and specifically the metals piece more broadly. How it works, to the second part of your question, really straightforward. So every token on metals.io is backed by physically allocated material that's stored in custody. And so what that means in the case of uranium and rare earths is your holding of that token is your essentially warehouse receipt and beneficial ownership, held by a trust of those assets. And so that means you can take physical delivery if you want. If you've got a Cameco account or a Confidine account, you can take physical delivery of the uranium that you own proportionally in terms of the amount of XU308 you hold. Similarly, with the rare token on the metals.io platform, you can take, there are some minimums there on rare earth metals as you'd expect, but you can take physical delivery of that as well. And then we've partnered with another gold project that was already up and running, that has storage in Switzerland, that is regulated in Liechtenstein, that sort of, again, every token of the VNX gold on the metals.io platform can result in physical delivery, again subject to minimums. So what that means is this is not just a sort of on-chain representation or reference asset. This is actually about owning the physical and being able to take delivery of the physical should you want. And so for the end user, the experience is designed to be as simple as using a banking app. You onboard. If you need to make a fiat payment to fund your account, you'll need to complete KYC with our partner. Once you've funded your account, you can buy exposure to those physical metals. Right now, it's uranium, gold, and a basket of rare earth metals. We'll have 3 or 4 others coming very soon, certainly in the next sort of 6 to 8 weeks. And so the blockchain settlement layer is invisible unless you want to interact with it directly. And certainly what we did on uranium, which we hadn't done, I think last time we spoke in September, which was a big development, and we launched this in November. Users and holders of XU308 can actually post that as collateral to borrow USDC. So that's an over collateralized loan. So they can take their XU308, retain the long term upside. We believe they'll have exposure to uranium, and then but also borrow USDC to then kind of take advantage of any short-term opportunities in the wider Web3 ecosystem. So we expect to be doing that for other assets as well as making it even simpler by building vaults with combinations of assets, so people don't have to think about the specific metal they want to buy. They can just get exposure to certain thematic baskets. That will be coming in the very near future as well.
And how do you see Metals IO fitting into a traditional commodities portfolio with mining equities, physical metals when it comes to gold? And what are the advantages you think of incorporating something like access to digital receipt, warehouse receipt, as you were saying, for these commodities, perhaps over the more traditional methods of investing in the space?
Yeah, I think I think I should be clear that I'm not arguing against holding traditional as you would traditional mining equities. I think it's more that it's a different trade. So when you buy a mining company, you're buying management risk, operational risk, kind of permitting risk, balance sheet risk, and as well, importantly, equity market beta, right, which can have quite a big effect when we see increased volatility in the market. So you get all of that on top of the commodity exposure. So uranium's a great example of that, right? Uranium equities broadly were up about 40%, while the spot commodity price was flat. That's great if you time the equity move, but it's a good demonstration of that these are two very distinct return profiles. So what metals.io gives you is what we believe is some of the purest commodity exposure. So when you hold XU308, you have beneficial ownership of the physical material. The price of your XU308 tracks the underlying uranium price, not the share price of a company that might be hedged, diluted, or carrying a balance sheet that amplifies or dampens those commodity moves. And so I think for most people, they should look at potentially using both. So they'll hold the mining equities for the operational leverage, the dividend potential, kind of that wider upside, and the kind of physical commodity then as a direct hedge against supply and demand fundamentals. And so you get the kind of combination of being able to capture upside on either side of the macro drivers of the market, right? And so metals.io really makes the second leg of that strategy accessible for the first time again across a lot of critical metals with no minimum, because you can invest in sort of fractions of an ounce of uranium or rare earths. So there's also a diversification argument. So if you want exposure to rare earths, your equity options are limited. You're essentially choosing between a few different mining companies and a few juniors. With metals.io, you can instead own the underlying elements directly without the concentration risk of a single company's operational performance. And that's really where we see it as being complementary. Naturally, the two will have some level of correlation, as you'd expect. And so investors should be mindful of that. But we see it's a complement rather than an either or type of situation for most commodity investors, I would say.
You mentioned other commodities coming to the platform. Would you be able to potentially shed some light or give us a preview on what the plans are and what sort of metals and minerals you're planning to add up ahead?
Yeah, look, I think any metal that shares the similar sort of fundamentals that we see in uranium and rare earth become very attractive. And that naturally leads us towards the sort of PGMs, so the platinum group metals, as well as, other base industrial metals. So platinum, palladium, a good example, palladium in particular, highly concentrated supply. South Africa and Russia dominate production. The Russian dynamic creates some challenges there. And there's growing industrial demand, for from hydrogen fuel cells, catalytic converters, and it's a relatively underdeveloped investment market compared to gold. So it's very similar to what we see in uranium, right? Where uranium compared to gold, uranium financial investment, I think, has topped out by some estimates at sort of 40% of the overall spot market in uranium. It's very similar in a lot of the PGMs. And so the Iran conflict has intensified that case. Palladium prices spiked on supply chain fears, given Russia's role. And so we think actually that there's a lot of similar sort of there's a lot of similar drivers around the thesis for those PGMs that we think are quite interesting. So palladium's one that we're certainly looking at. And then I think, we've got a basket of rare earth metals right now. We're assessing how do we sort of break that out at the same time? How do we give specific elements like neodymium kind of priority? Because these are the building blocks of the permanent magnets. So as mentioned before, they're critical for EVs and wind turbines. And then, the metals piece, we also are looking at cobalt, we're looking at nickel, and of course, silver, which has both an industrial use case as well as the sort of precious metals use case as well. The pipeline, I would say, is deeper than people might expect. And I think what's really interesting is in some of these markets, if we're able to deliver on the promise and get the traction that we expect to get through metals.io, we're having some very interesting conversations with producers and some more of the existing supply chain participants and traders in the metals markets about how this can be relevant for them as well.
Well, what are the main catalysts you would say coming up, news flow coming out of metals.io for the remainder of 2026 and beyond that people should be looking out for? Obviously, bringing these other metals and minerals to the platform is a big one. And how do you see this project advancing? What can people look forward to?
Yeah, look, I think there's several things to watch. I think we covered new asset listings in the previous question. So we're very close, sort of 6 to 8 weeks away from another tranche of metals coming to the platform. And so each of those new assets expands that investment universe and brings new communities onto metals.io. A lot of advanced conversations there. I think institutional partnerships that I referenced as well are quite interesting. So we're discussing with a lot of institutional counterparties. So, infrastructure providers, commodity focused funds, commodity traders, family offices, about how they best integrate and can support and partner with us to broaden liquidity and also the platform's reach. So I think that's really exciting. I think for metals.io specifically, we're investing in a lot of capabilities. So I mentioned the kind of use of XU308 as collateral through uranium.io. We want to extend that to the other metals as well, because we think it suits both sides of the lending and borrowing market. As well as, investing more in the broader UX experience. So the vaults piece, or model portfolios, as we call them in TradFi terms, we're very close to sort of being able to announce a partnership there as well. And so, our focus on the UX side is really being metals.io being a fintech product that anyone who's got crypto experience or not can interact with. And so it's not purely just meant to be something that's relevant for Web3 investors. And, the ETF pathway is also really interesting. So what we saw and what our learnings from Uranium is there was a lot of institutional demand that liked what we'd built and understood the thesis of why we'd built what we'd built, but wanted a product wrapper around it that would satisfy ease of transactions and their risk and compliance teams. And so it's public information. I can't say too much about it other than that it's been filed, but there is a US ETF that's been filed that will hold XU308. So that's exciting times as well. If we get that right, I don't want to kind of compromise our position there, but if we get it right and we get it approved, then I think others can follow that pathway. I think it unlocks quite an interesting opportunity there. And frankly, the macro environment has been its own catalyst. So, every time there's a news story coming out of the impact of the closure of the Strait of Hormuz, every new Chinese export control, every central bank gold purchase, all of this drives investor awareness of the exact problem that we believe metals.io solves. So I don't think we need to create demand per se. I think it's about how we emphasize that we can satisfy that demand very easily with the platform that we've built.
Excellent. Great conversation, Ben. I'm going to put a link in the description below to the metals.io platform for people who want to check that out. Thank you so much for coming on the show and sharing your knowledge with the audience.
Always a pleasure. Really appreciate the conversation. Really interesting chat. Thanks very much.
Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.